Good morning, Whitney, and thank you for joining. How are you doing this morning?
I'm great. Thank you very much. Thanks. I appreciate your time this morning.
Yeah, thank you so much. I prepared a couple questions for you today on my end, and then I took some questions for the audience. So let's go ahead and jump right into this.
Great.
One of the first things I'd ask is I turn on the news and you hear about unemployment at over 20%. You have oil at all-time lows, and yet the stock market is only coming in today down around 15%. Can you talk a little bit about where the market is now and how we got here?
Great. Yeah. I mean, I would say despite what we saw yesterday, today, we've really seen a very rapid recovery in risk assets over the last 4 weeks. So if you think about it, the S&P is, up about 20% or so from the March 23rd lows. We've seen the Bloomberg Barclays High Yield Index. The option adjusted spread has really compressed by about 400 basis points or so. Equity market volatility is still high, but it's subsided substantially. We saw it, at its peak around 82. It's down almost 40 points since then. This is really due to a combination of massive monetary and fiscal stimulus, provided support for the market, allowed buyers to emerge to take advantage of some of these cheap prices. I'll say that the optimism seems a little misplaced. We're seeing that between yesterday and today and some points you talked about with the price of oil. But the price that you're paying today is really, still, we'll say, pretty rich for what we see as an uncertain future. We expect fundamentals are going to get worse. I'm sure you probably have some more questions kind of talking through these things. But one of the things that we really don't know, and markets don't like uncertainty, is when things are going to open back up, how quickly things are going to normalize from here.
Do you think this most recent fiscal stimulus is about to be passed and put into action is going to help things in the near term?
Oh, I do think it will help things in the near term. Certainly, any time that we have this kind of stimulus, it's what the markets are looking for. So if we think about kind of taking a step back about looking at what we're seeing from the cause of this current crisis and how the markets have reacted. So this cause is very unusual. We have never seen a demand shock like this before. From a market standpoint, though, it's very similar to crises that we've seen in the past. Even though the cause is very different, the response is the same to some degree. If you were to look at, Russia defaulting, Enron, global financial crisis, the initial shock is really a lack of information where we don't know the scale of the problem, what governments will react to the policy response. And that's the key thing, is that policy response. So once we get an idea as to how governments are going to react to it, and in this case, what they're doing, they're throwing everything, everything, the kitchen sink, the table, everything is getting thrown at this. That is very positive for markets because we know that, you kind of go back to that term, everything it takes. That's what we're going to see, and we'll expect to continue to see that. So that will certainly be positive in the short run. Long run, there may be different implications of that, but certainly that will be positive for the market.
Okay, so you're talking a little bit about recovery. When we hear a lot of market commentators speaking on television, they talk about lingo such as retesting the low, a U-shape, V-shape, W-shape recoveries. Can you talk a little bit about those terminologies and what you guys are seeing on your end as far as the recovery?
Yeah, there's a number of terms that are being used to describe what the path of the potential recovery will look like. So V is the most optimistic. So essentially what this means is you're going to have a rapid bounce back. So the U.S. returns to its previous level of activity in the third quarter of this year. Now, to kind of put that into perspective, after the global financial crisis, the recovery took an L. It dropped. It took a very long time to recover, about 3 years. That's one of the slowest recoveries that we've seen on record. A U, which is another term that's out there, and I think that probably the majority, if you look at forecasts, are looking more at a U shape. It's going to be slower, but still a fairly rapid return. The W is one that we think is having increasing likelihood. We think that V is a little too optimistic, and we see the likelihood of a W. A W essentially means that what you're getting is the virus lingers, it comes back. So we sort of have what I'll call rolling shutdowns. which means we sort of get things back to, I don't want to say back to normal, but we start to reopen the economy. We see that, say, in the fourth quarter, the virus comes back, reinfection cases start to come back, and we sort of have these gradual lockdowns as we respond from a market perspective. I'm actually going to throw another word out there, which is kind of interesting. I heard this yesterday, and it's a swoosh. So it's more like an elongated U. I mean, essentially what we think is that you're going to have some form of social restrictions that are likely to persist into the third quarter. You know, the scale of this demand shock is going to cause a shadow over growth for the foreseeable future. So we think that a V is a little too optimistic, and that the likelihood of having that W where we actually see the virus reinfection come back towards the end of the year is increasingly likely.
Wonderful. When you briefly mentioned this, but when comparing this to past economic disasters, how would you frame that? You know, on our end, we're trying to say, hey, what does this look like if we compare it to the Spanish flu or some of the other things in the past? Can you give a little color on that?
Yeah, I mean, essentially, if you look, this is kind of interesting. So if you compare the pandemic to what we've seen in the past, it's from a mortality rate or a fatality rate, it's actually relatively low. And what we've seen is just the massive response from a government standpoint, from our healthcare standpoint, to really take action. And, you know, I kind of touched on this earlier, but one of the key things is how do we respond from a market standpoint? So we know that there are, and we can look actually to some of the Asian countries that have kind of dealt with these kinds of things before. If you look back to SARS or MERS and how they've responded, it's really good information for us moving forward. But if we think about this from a market standpoint, although the cause is very unusual, you know, certainly that's quite different, but the response is really the same. So as I said, you know, that lack of information, markets don't like uncertainty. So if we think about the one thing that markets really don't like, it's about not knowing. That's the first phase of any market crisis. They can deal with bad news. They just need to know so that they can then make informed decisions. Well, if we think about it to kind of what we've seen in the past versus how this is today, we're past that first phase. So although the results or the cause is different, that lack of information is really part of what drove a lot of that during the first, I'll say the past, you know, month or so, is really not knowing. So what is the virus? What does it do? What's the duration? How long are we going to be locked down? That was really, you know, some of that was really what was flaming what we saw over the last 4 weeks. Today, I'd say we're in the second phase of this. So what that is we have less uncertainty. So we know that there is a way to mitigate the virus. You know, it's very extreme, certainly, but there is a way that we can mitigate the infection cases. So then you're balancing how do we come out of this. But we're really in the eye of the economic storm, and this is more familiar territory when you think about it from an investment standpoint. There are ways as a team or an investment desk that we can go through this, and this is really what, you know, kind of the essence of active management is that you have a process in place that you can cope with this kind of stress because we have more information now and we're just looking at economic data going forward. Still some unknowns. I don't want to minimize that fact, but it is much less uncertainty than we had, say, a month ago.
Okay, so you're talking about being in the eye of the storm. One of the biggest things that I think concerns a lot of investors is the volatility. How long do you think that's going to persist? And then do you think it's going to persist at the same level we're seeing today, where markets are going up and down by 2% and 3% every single day?
I have to say, I think it's going to be choppy for some time, quite honestly. If you think about the fact that we're starting to, I'll say, reopen the world. That's such an interesting thing to say. But we are starting to get a plan to move forward. And there's a couple pieces to that. The first is the economic data. I think the data that's going to come out this month, next month, it's going to be pretty awful. I mean, you threw out the unemployment number. We're expecting another huge number, coming up here. And we're going to see some pretty significant bad numbers over the next couple of months. So while we expect that, I think that you're going to continue to see markets being very choppy. And then, of course, you have the whole concept of what's happening from an oil perspective that we've thrown into the mix of this. So we do expect that we're going to be choppy going forward. I mean, if you think about it, since this happened, every major index around the world has rallied. There are certain degrees of richness. Some still look pretty cheap, but we think that it's really, I think when you look at how markets have rallied, it's really, in our view, kind of gone too far too fast, and that we think it's going to run out of steam. I mean, we're really just at the start of earnings season. We're still processing the impact of corporate earnings. So I would say, as we look out over the next couple of months or so, that while there's opportunities and you can be very tactical through this, we would expect that you're going to see a lot of volatility going forward, certainly in the near term.
When speaking about that volatility, what do you guys see in the near term as the potential downside versus maybe upside, just short term?
In the short term, I mean, I think where we're looking at that, parts of the market have really gotten cheap. If you came into this, kind of at the beginning of the year, U.S. stands out as an area that, from our perspective, we thought was really overvalued, and everything has gotten cheap. It's just the degree of cheapness if you kind of look at it from that perspective. So there are some really interesting parts of the market from an opportunity standpoint, those markets that have really seen, I'll say, the most severe damage. So if you look at, small cap versus large cap, looking back to history, what's performed well when you come out of a recession or come out of recovery? So if you go back to, say, 2015, 16, certain parts of the market, so down in the cap spectrum, again, small caps, mid cap, emerging markets, that's an area that's pretty interesting from our perspective from evaluations. International, cyclicals, value, we'd expect greater opportunities there. We think there's really too much optimism around corporate earnings, especially in the U.S. From our perspective, our investment desks are really super selective about what sectors they're looking for, or what they're looking at. I saw a great quote from one of our portfolio managers, and, he kind of called it quality on sale. So, essentially they're looking for quality companies that will be able to get through this and then perform in a recovery standpoint.
If you were to narrow that down, what areas in particular industries would you be investing? Maybe let's just say within the U.S., as most of the investors here are more focused on that side. And then if we look at emerging markets, maybe on the country side, which countries do you see the best opportunity?
All right, well, that's a loaded question from the country side. I'm going to say it's country by country.
Okay.
And really the key for that is, and we actually use a country model that, so kind of from two perspectives. So if I'm thinking about different investment desks, sorry, I'm starting on international, and I'll come back to U.S. Kind of bigger point is I will say from an emerging market standpoint, we are looking at a number of things from a country perspective. So one, which economies have sufficient resources to survive going forward? So you're thinking about, having hard currency reserves that they can cover lost revenues from exports. Can they cover essential imports? Are they able to access the IMF? I mean, these are all different things that are kind of standing out. So I'm going to say Turkey, Chile, South Africa. Those are some areas that we would think would fall kind of at the lower end from that perspective. Thinking about it from kind of a step back across international and emerging markets, I'm going to say that it is more about identifying opportunities from a company perspective. And when we look at it, we're looking at it, and this is actually whether you're U.S. or international, it's trying to identify those companies that are not as reliant on global trade or a macro perspective in order to be able to perform. And that's really important. And actually that's something that we were doing before this, which I think has actually been really beneficial, because if you were to look sort of across our strategies, they actually have a quality bias. And that's been really beneficial when you think about what has actually, I'm going to say, held up best or been more resilient and provided some of that downside protection when we look at what happened over the first quarter. So having something that has that quality bias, the key right now is actually, and this is one thing that, we've gone back and have been speaking with all of our companies, is what is your access to cash right now? Because it's less so, quite honestly, about how much debt you have, but what is your access to cash? What kind of liquidity do you have so that you can survive through this? That's really a key thing right now. When we think back from a U.S. perspective, and thinking moving into cyclicals, might be a little bit early, I'm going to say. We are finding some select opportunities. When we think about cyclicals, that would be those companies that are most exposed to global trade, manufacturing cycle versus defensive. As I said, it's kind of broadly a little bit early. We are quite honestly a little bit cautious and patient because we think that there's going to be more opportunity coming forward, but certainly very very tactical going forward. Again, it's really about finding those good companies at cheap prices, and there's really a lot of opportunity to be doing that right now. In the U.S., from a cap perspective, actually this is specific. This would probably relate to international as well, is down the cap spectrum. We do think that small cap is actually an area that you really would have a lot of upside going forward.
It seems that just when we're looking at the market returns, most of it's really been segmented towards technology. It's been a good place to hide, so to speak. Do you think that's going to continue? Or would you really be looking for those opportunities that you mentioned more in some of the beaten down areas or the small cap side?
In the very short term, I think you've seen some of those very large companies actually, I'm going to say, hold their own to some degree. And it's been a really interesting. So what you would typically expect is healthcare, biotech. It's actually done really well. That's an area that you would not typically expect to see perform as well as it has. Actually, at a period of time, it was outperforming consumer staples, which doesn't really make sense. This has really been a very different kind of environment than we typically have seen. But to your question, if you are thinking about where has what parts of the market have the greatest opportunity to outperform, and this is, I'm going to say, kind of looking a little bit more long run. It's not about market timing, saying this is what you do today, but thinking about those parts of the market that have the ability to outperform going forward. It is actually some of those beaten down. So it's some of those small caps. And if you think about it just in terms of the ability from a growth perspective, that, those very large companies that have actually really driven much of the growth of what we've seen, or much of the returns that we've seen recently, are, driven by a handful of names. And while we think that they have some stability, and not saying that they're going to massively underperform, but their ability to grow at the same pace as some of these smaller beaten down companies isn't as high. So we would expect that going forward that you would see more opportunity in some of those small caps, some of those beaten down names, and, say cyclical is the value part of the market.
Thank you. What about talking about the path to reopening? What does that look like from your guys' perspective? I know you mentioned, and then I know you mentioned a little bit about the potential for resurgence, if you want to hit on that point as well.
Yeah. Well, the first thing I'm going to say is it's not like turning on a light switch. Everyone talks about we're going to open the economy back up, and states actually, because states actually following certain steps that have been set forward by the CDC and the White House, is really about the economy started to shut down before any of those stay-at-home orders were issued. So if you look back to China, for an example, and trying to see kind of how they've done, and I'll touch a little bit more on that, but the key is really understanding what potentially happens from a second wave of infections, and what does that mean? Because that's really the key that could have more prolonged disruption, not only to, normal economic activity and recovery, but because it also could change our behavior. So if we think about what does it look like as we move forward? You and I were talking a little bit about at the beginning of the call about how different it is from a regional perspective. So where you sit in the country, where you sit in the world helps to inform how you're going to behave. So certain parts of the country are reopening earlier, and, we're already seeing that. And what we really want to watch is what is that case of reinfection. What we're looking at, and it's kind of interesting, we have something that's called a data insights unit. So it's a team of data scientists, and they essentially just analyze enormous amounts of data they can scrape off of the internet. They help our investment desks make better decisions. Well, essentially what they're doing right now is actually looking at what our exit scenarios we're looking at. So they're looking at things like impact of lockdown policies on reinfection rates. What actually will policymakers allow? That varies versus the U.S. and other countries. And how can you reopen countries and maintain the lowest rate of infection? There are certain parts of the world, certain regions that will be liberated faster and will have lower infection rates. So if you were to look at Beijing or Wuhan and you look at traffic patterns, we actually see that there's a rush hour. So we're, after being closed, we now are back to having a rush hour. It's reduced, so not as many people are back to work. What's really interesting is that outside of that rush hour, traffic is a fraction of what you saw before. So you're not going to turn on a switch. The economy isn't going to kick back up. What's going to happen is you're going to see, and I do think that this will be regional if we're talking about the U.S., is that you will see a gradual reopening. It will vary based on what kind of reinfection rate you get across the country, and that you'll see that kind of ebb and flow as you potentially see an uptick in reinfection cases. People, whether or not you officially open the economy, will change their behavior. If you're sitting in the D.C. area, you might have a very different propensity to go into the grocery store than, say, if you live, in New York City or New York State in a couple of months or so. So I think we'll see a gradual return and very specific from a regional perspective.
How do you think that's going to correlate to the market? So I know we're talking about the short-term potential for a U-shape or V-shape if the virus does resurge. How does that look a year from now? What are you guys expecting as far as returns from where we are today?
Well, I think a year from today, I think we're in a much better position, quite frankly, because, there's a number of things. So, and I don't want to sound really negative as I talk about this, but there's also a lot of positives that's going on. So a year from now, we are that much closer to, one, having treatment. And, a lot of what we're seeing from a healthcare standpoint is really positive in terms of being able to treat the disease or treat the virus. Because, initially, as I said before, it's that, phase one, it's just we don't even know what we're dealing with. Well, in 6 months, in 12 months, we're going to have a lot more information. We're going to be that much closer to, one, either having a treatment, and, we're seeing more encouraging news coming out, or having a vaccine. You have to look a little bit further out, say 12 months for that. But when we think about it, from an economic growth, we've really been talking about, it's been, fairly anemic for a number of years. And what we saw is that, COVID-19, it just really reinforced our concerns that growth is going to be weaker rather than stronger going forward. So as we go forward, we're removing a lot of uncertainty, advances from a medical standpoint. I think that's going to be really positive. When we think about how we should be positioned going forward, it's about identifying those companies that, from our perspective, have much more of a quality bias. And what's interesting is, a lot of people, when you think value, of course, you're thinking, less quality. You can actually have a quality bias, whether it's in a value strategy or in a core strategy, international, U.S. As I said, it's really about trying to find a way that you can actually, when you start dipping back into some of those more risk assets, is if you can find strategies that you actually have the ability to protect on the downside, but also participate on the upside. That's really the key as you move forward. But I certainly think, 12 months from now, we'll be in a much better position than we are today.
Okay. And then I have a couple questions from from the audience. One in particular was when we look at the mountain of debt that we're taking on during this crisis, how do you see the markets performing, when we look at 3 to 5 years down the road?
Oh, that's a great question. Well, what I can say is, if you think about certainly this is a massive amount of stimulus. There's going to be, consequences from, looking forward from that perspective. One thing, if we're thinking about it, what happens, likely to have higher taxes going forward. That's something that we certainly think, looking down the line, you're going to end up having to pay for this. Markets, when we think about where we're priced right now, in terms of looking at it from a rates perspective, is that we would anticipate, they really do look like they're priced at having, staying with rates very low from that perspective. Interesting when we think about, where we would anticipate if you're going to have kind of inflation, deflation, is looking more like a Japan going forward, quite honestly, in terms of it being, kind of as we look forward and how we see ourselves in the next 3 to 5 years. It's certainly, we've had significant fiscal stimulus, and the question, I guess, is, are we going to have more repression going forward? And that's already reflected in what we're seeing from a market price standpoint. It's really where we're seeing a yield, say, on the 10-year Treasury is really more consistent with the Fed keeping interest rates at zero, around zero, for the next couple of years. And we're really less concerned. I know a lot of people are concerned about inflation. We are less concerned about inflation despite the level of stimulus that we've seen.
With interest rates this low, and potential at some point for them to go up, how do you see bonds playing into a portfolio?
Well, that's one I'm going to say that's a little bit of a question that depends on the risk tolerance. So I'm going to throw that out there to start. Second, if you're going into bonds, and I will say that is an area that's attractive right now. Certainly, if you look at what's happening from a stimulus perspective and the government and QE, that everything they really stepped in to stabilize or have a buyer, for certain parts of the market. If you were thinking about fixed income and bonds, what I think is really key is having flexibility in your fixed income portfolio. There's a lot of opportunities out there. One thing that a lot of people talk about, is duration in their portfolios. And when yields get this low and you start thinking about lower for longer, there's a tendency for investors to extend their duration in their portfolios. From our perspective, we actually think that you should look at duration, and the price that you pay for duration, the same way that you think about credit quality. So when you're thinking about building a fixed income portfolio, you want to make sure that you are paid as you dip down in credit quality. You also want to make sure that you're paid as you extend the duration of your portfolio. So don't take that duration risk if you're not paid for it. What that translates to from our perspective is that when yields are very low, you're generating less income. You have less of a cushion for when rates start to go up. So we think that the key is really, one, ensuring that you're paid as you dip down in credit quality. And I will say, from that standpoint, depending on what parts of the market you're in, we do think that there's a lot more. We'd be looking very closely from a default perspective. We've already seen a lot of those, bonds they call them fallen angels. So going from investment grade into the high yield category, despite a lot of the stimulus that is coming out and support, you are going to see bankruptcies tick up. You're going to see defaults tick up. Same thing from a duration standpoint. Don't extend those portfolios if you are not getting paid to take that extra duration risk. So the key is really having a flexible approach. That means that you can participate, you can get good risk-adjusted returns, and you have the ability to access those parts of the market that are offering the best opportunities. And kind of the step back when you saw those markets freeze, again, kind of that comment about quality on sale is a lot of people were selling out of their bond portfolios, and managers were selling whatever they could versus what they should be selling. So if you had dry powder, if you had any cash on hand, if you were more defensively positioned, you really had the ability, and I think you're going to continue to have the ability when we have these bouts of volatility, that you can actually find some really good high quality assets at more distressed prices.
Thank you. Looks like we've run out of time for today. What I'm going to do is, if anyone wants to email me directly or give me a phone call, I can be reached at 703-287-7128, or email cgrund@sfpfinancial.com, and I can go ahead and coordinate with Whitney to address any additional questions that anyone may have. Go ahead and thank you again, Whitney, for joining us this morning. And that will conclude our phone call. Yeah. Thanks, everyone, for joining, and hope everyone has a great rest of their morning. Take care.